So we're getting to fun stuff now, calculating returns and then risk. So a return, so this is real critical that we get this real clear. We'll probably do a team competition on this maybe next week. Be a good practice for the final exam. So we need a holding period return. Holding period can be any period of time. It could be daily, it could be weekly, but for most people, it's going to be, what do you think? What's the most common? Monthly, don't you think? That makes sense? How did I do this month? Why is that? Because there's always 12 days in a month. There's no holidays we have to worry about. There are some months with 30 days and 28 and 31 and all that, but there's 12 months. So monthly is really important. Annual, sometimes if I'm building a model where I'm looking at the last 40 years, annual is good enough. I don't need monthly data. But monthly is the most common. Now at USA, we did stocks daily and bonds monthly. Bonds are really hard to do daily because you don't get really good prices. And in real estate was quarterly. Why is real estate quarterly? So you don't have any prices. It's appraised values and that kind of thing. So, but bonds are a little trickier. So it just depends. But we could look at our stock returns every single day. It's really pretty easy to do. So you need a holding period. Once you pick that holding period, you're going to calculate the holding period and all the others. So if it's monthly, you're going to have this month, last month, the previous month, and you're going to collect a bunch of months. All right. So the holding period is just 1 month. And then what we're going to do is take a bunch of those months and link them together in some way to look at performance and risk. All right. So the first thing we do is just figure out what the last month was. And the formula we are going to use is this formula. Now, notice on the fact exam, they use almost the same formula. So it's the same mathematically. They do, well, ours is going to be ending market value minus beginning market value. That's your capital gain. Have you heard the term capital gain? That's your price gain. Plus, not income, but what kind of income? Accrued income, which means it's not cash. So that makes a difference. For bonds, you probably covered that in your accounting classes. The accrued income on bonds is kind of a pain, isn't it? Remember that? You had to do the interest method. You got to figure out exactly how many days there were and all that. We're not going to do that here. We're only going to do it with stocks. And we divide that by the beginning market value. Now, the fact exam leaves out beginning market value, the same equation, and then they subtract 1. It's mathematically the same thing. So you can take any market value plus income over beginning market value minus 1 and get the exact same answer as this. So either way works. So if you take the fact exam, don't get confused on the formula. They're the same. So I was watching last week, we did the fact exam review and he used the -1 formula. But now, is this the right formula? It's not allowed, but we're going to use it because it's nice and simple. The allowed formula is the modified Dietz. That's what the Chart of Financial Analysts Society says, modified Dietz. We use modified Dietz with our student portfolio, but we'll talk about the difference in those. So one problem with this formula is you notice it doesn't say anything about purchases and sales. So what if you had 1 share at the end of last month, but on the 20th this month, you bought 1 million shares? That would be important, wouldn't it? That's kind of a big impact. This completely ignores it. All right, so the modified Dietz, you can go out there and look at modified Dietz. It's out there on Wikipedia. If I can spell modified, and they'll give you the formula. It looks real similar to our formula. But the strange thing is they subtract the income, the F, but it's because of the adjustment of what they're doing below. So if you look at the formula, it does make some sense. If you want to see this formula live, you can come look at our portfolio, have it set up so it does it. But with this formula, if you have cash flows during the month, including your income, you have to weight it for the number of days. So it actually adjusts for when the cash flows came in and left. So that's what they're trying to do. It's a time weighted return. I don't know if they talk about time weighted. Oh, there it is. Time weighted versus dollar weighted. Do y'all know the difference in those two? We'll look at them when we see it. So what do you care about? You care about dollar weighted returns because that's your actual return. When I did my wealth management class, I showed them how to calculate their returns in that Excel spreadsheet. That's a dollar weighted return. We don't use dollar weighted returns in finance. We use time weighted. Why? Because the portfolio manager doesn't want to be graded down because you showed up on the 20th of the month with a bunch of cash before the market crashed. That's not their fault. They didn't do that. Or you showed up at the beginning of the month, the market shot up right when you bought and you missed all that, so you should have gotten a big return on the first and second, but you bought on the third, you missed all that. So what the stock market says is, hey, we don't want to be dinged by the timing of your cash flows. So what this formula is doing, the reason you see a minus, what this formula is trying to do is take the timing of the cash flows out of the analysis so it doesn't affect it. It doesn't matter when you bought in the month, they're going to look at your return on a time weighted basis. A dollar weighted is real important, which to you is really important. If you invested $1,000 for 11 months and in December you put $1 million in and the market dropped in December, you lost a lot of money because you had $1 million, but the time weighted won't see that. It'll assume you had the same amount the whole year. But that's the official modified Dietz approach. You can see we need a lot more information. We have to know exactly when the cash flow happened. So if you'll see what I do in the investment society portfolio is I have to have a date for every trade. I have to have a date right when the dividend was paid. That has to come in there. So I have to have all those dates or I can't calculate the modified Dietz. But on the exam, we're going to use this approach. Now, the accrued income, we're only doing stocks. So you should have learned bonds in your accounting class. So bonds, you don't accrue income based on when they pay it, but you accrue. If it's 3 months before the next interest payment, you're going to accrue the 3 months that it just passed and put that in your income. Now with stocks, we're going to accrue income, which is dividends. That's the income for stocks. What is the right day for dividends? So there's payment date, there's X date, and there's announcement date. There's only one of those dates we really care about, and that's X date. So on the exam, I'll give you all three of them: X date, payment date, and announcement date. But X date's the only date that matters. And what X date means is if you own the stock on X date, you will get the dividend. So if it goes X today, let's say a $1 dividend today, and you own the stock today, but you sell it tomorrow, a month from now, you might get $1 on that stock because you owned it today. And so what happens on X date? On X date, the stock price will fall by the dividend amount. So you might say, hey, it went X today, so it fell by $1. I sell the stock tomorrow. It says, well, I lost $1 because I didn't get the dividend. But you are going to get the dividend. So the stock falls by $1, but a month later you get $1. You're okay. So on X date, and I may show you next class. I keep forgetting to do this, but there's a stock, a $40 stock we own in our portfolio, and they paid a $10 dividend. I remember pulled our portfolio, and our stock was down 25%. It's like, my word, what happened? Did they announce some bad news? No, they paid a $10 dividend. So the stock falls $10. Why? Because the company just agreed to send a lot of money out to their stockholders. Obviously, the value of the firm came down. If you're going to send $10 billion out to your stockholders, your company's worth $10 billion less. But their stockholders are no worse off because they're getting the $10 billion. If you own the stock on X date, you don't have to worry about that. The stock falls $10, but you're going to get $10 in a few months or a few days anyway, so you don't care. So X date can be really, really critical. So look for the X date. Now the payment date works into that modified Dietz. So that's why the payment date is important. But for us, we're going to ignore that. We're just going to look at the X dates. So let's work some examples. Let's try good old Walmart. Does Walmart pay dividends? We looked at their dividends, didn't we? Did we look at their dividends? I can't remember. Maybe on the class. How predictable are Walmart's dividends? Didn't we look at this? Pretty predictable, aren't they? They paid 56 cents, 55 cents, 54 cents, 53 cents, 52 cents, 51 cents, 50, 49, 48. Anybody want to guess their next dividend payment? Probably be 56 cents, right? They got 4 of those and then 57, probably. Or what if they do 72 cents next time? Or what if they do 40 cents? Will the stock market notice? Yeah, they'll definitely notice that. All right. So let's look at historical. So this dividend date is the X date. What they're giving here is the X date because that's the only date we really care about. It's not the payment date. It's not the announcement date. On the announcement date, they could change their mind and not do that. And they change it. Once the X date happens, they have no choice. They've got to pay that dividend. They're on the hook. So the X date's the most important. So they pay they went X on August 11th. So let's figure out their returns for August, September. So let's do this. We'll do August. No, let's do July, August, September. So we need an ending market value, we need a beginning market value, and we need accrued income, and then we're going to get the holding period return. So what would be the ending market value for July? What date would that be? It's not a trick question.
The closing on last day of June.
So here we have it right here, right? July, with the ending, not the beginning.
Oh,
So the ending is 132.05. But yeah, Borno, you're right. So what's the beginning? It's beginning July 1st or June 30th? June 30th. So the beginning is the last day of the previous month. So June 30th. Looks like they had a good July, doesn't it? 121.58. What accrued income did they have? When did that dividend go to X? August 11th. So 0, isn't it? What's the beginning market value for August? Yeah, ending. So those two have to match. Otherwise, we're going to be missing some returns. And so the August end date, ending value, be August 31st, 132.55. Doesn't look like they had a very spectacular, but they did pay a 56 cent, or they didn't pay, they went X 56 cents. All right, so that's going to help. And then my beginning market value there is going to be August. And then my September ending, September 30th, 129.70. Didn't have a good September. Y'all see where I'm getting all these numbers. That makes sense. And so the holding period return is going to be ending market value minus beginning market value plus income divided by beginning market value, or ending market value plus income divided by beginning market value minus 1. So equal ending minus beginning plus income divided by beginning. They had a really, really good July. Ending, I'll do it the other way, plus income divided by beginning minus 1. 0.8%, we get the same thing for either formulas. 0.8%. And then the last month, not too good. Ending minus beginning plus income divided by beginning. So had a down month. How many months would you go back with Walmart? You can go back to the 70s if you want to and get monthly returns. They were a small cap stock in the 70s. Now they're a large cap. Are they a value company or a growth company? Well, you'll see they have a really high PE ratio. We'll talk about that. I mean, to me, it's pretty amazing. Walmart has a PE ratio of 28. So their earnings is $5 and the stock trades for $140. So you're paying $140 for $5 in earnings. Let's look at another firm, Moderna, trading for almost the exact same price, but what are their earnings? Their earnings are $34. Why would you pay $140 for a firm making $5 and you only pay $137 for a firm making 6 times as much money? What do we know about Moderna? Was their last year the best year ever or an average year? Pretty good year. Unless we have another pandemic immediately, they're probably not going to repeat that again. They were losing money before the pandemic. So, makes sense. Is Walmart a growth stock? 28 is a really high PE ratio. We're going to see PE ratios are high for growth stocks. They're also high for low risk companies. Which do you think Walmart is? A high growth company or a low risk company? Probably low risk. I mean, they could be high growth, but they haven't been growing all that fast here. So that gives you their return. Those are holding period returns. We could go back very long. On the exam, only give you 3 months, which doesn't make a lot of sense. 3 months doesn't tell you months. But each one of these is a holding period. There's July's holding period return, August, September holding period return. We now have 3 numbers. Okay, let's practice it one more time. I'm kind of curious how NVIDIA has done. How have they done last year and a half? I noticed I saw Pelosi on there. Her husband had bet on NVIDIA stock going up. We talk about all the insider trading of Pelosi and all that, but they actually don't do all that well. They're actually pretty horrendous, which kind of tells you the kind of people we elect to Congress. They have inside information and they don't invest very well. So yeah, it's not really helping them all that much. So NVIDIA last year doesn't look too good. Well, let's see how they've done. So it looks pretty flat this last few months, but we'll look at it, historical data. Now, do they pay dividends? Probably not, right? 4 cents. That's almost, a 4-cent dividend. You have to wonder, why does a stock trading for $130 even bother to pay a 4-cent dividend? So it's like, why waste your time? But they did. So September 7th, they paid 4 cents. July, they paid 4 cents. That's or June. That's June, they paid 4 cents. So remember that, September, 4 cents. That's the X date. So if we're going to do NVIDIA, we'll do June, July, August. Need ending market value, beginning market value. So July's beginning market value is June 30th. So they start at 159, 151.59. Their ending market value in August and July. Whoa, that looks pretty good. 181.63. What's their accrued income? 0. Because when was it? It was September, right? 4 cents in September, so nothing there. There's their beginning market value for August. Let's look at the ending 150.94. That doesn't look good. That's your beginning market value here. And in September, you see the ex dividend right there. You could say, you know, stock price fell by 4 cents, but you ain't gonna notice it because a bunch of other stuff happened that day too. But it's in there. That stock price did fall by 4 cents, but it might have gone up. It went up $3 for other reasons, so you can't really see it in there. And then 121.39. That doesn't look too good. This is a very volatile stock. So we saw July, we saw August, we saw September's. So that's what you're seeing. Doesn't look too good. All right. So again, we take the ending market value minus beginning market value plus income divided by beginning market value. Wonderful return. They started out at $151, ended up on 121, made 19%, lost 17, lost 19. So which of these two stocks is more volatile? Is it pretty obvious? You don't need to calculate numbers. What could you calculate to figure out what's more volatile? What did you learn in your stats class? Standard deviation, you remember that? So who has a higher standard deviation here? It's pretty obvious that it's NVIDIA, right? 22% versus 5%. And that's monthly data. How do we annualize? You remember how to annualize standard deviation? We don't multiply by 12. What do we do? You remember your stats class, you can annualize volatility, but you can't annualize standard deviation. So how do you annualize standard deviation? Anybody remember? When did y'all take stats? Not 1/12, no. So I remember I took stats and I was like, man, this is a boring class. I don't have to do this again. And discovered it was the most important class I took in all of undergraduate. It's like, wow. I always think they should teach that in the business building by a business professor, not by a math department, because they don't realize how important stats is to finance. So you can't multiply by 12. So we multiply by the square root of 12. Because volatility is standard deviation squared, right? So you can take volatility and multiply by 12, and then you have to take the square root to get standard deviation. So if you want to annualize standard deviation, you multiply by the square root of time. What if these were weekly numbers? What would you do? You don't multiply by 52. What do you multiply by? Square root of 52. All right. What if it was daily? That gets really tricky. There's 365.25 days in a year. That's true. But there aren't 365.25 trading days in a year. There's only about 270 or so. So daily gets really, really tricky. You see another reason why we like monthly, because are there 52 weeks in a year? Well, more or less, but there's definitely going to be 12 months in a year unless we change something strange. So that's theirs. 19% versus 76%. This S&P 500 has a standard deviation of about 18%. Walmart's essentially in line with that. NVIDIA is much more volatile. All right, we'll do one of these next class, but there's more we got to do with it. So those are just our holding period returns. Now we got to figure out how we're going to link them together to assess the return over a longer period of time. Because we've got a bunch of months, that doesn't tell us something. So how are we going to put them together? And there's two ways to do it. We can do it arithmetically or do it geometrically. Arithmetic is really easy. If you have 3 months, you add them up and divide by 3. That's real straightforward. And if you want to annualize it, just multiply by 12. And your stacks class arithmetic average is probably what you refer to as the expected value, as the mean. So if you're running a model, creating a model where you're gonna simulate something in the future, you would use the arithmetic average. However, your true return is your geometric average. What's another word for that? You probably remember in your stats class doing in your maybe accounting class, internal rate of return. You remember that? So the geometric is your internal rate of return. It's what return gets you from what you started with to where you ended up with. And that's what you really made. And the Excel spreadsheet I used in my wealth class, we're actually using the geometric internal rate of return because it's your true return. It's what you really did. How do you do that? Well, geometric is a lot more work. Now, I've been looking in Excel. People could keep telling me Excel has added this formula. I have not found it yet. So if y'all find this formula, let me know. Excel does not, as far as I know, have a geometric link. But you have to take 1 plus each period's return, link all that together, and then take it to the 1 over n. So you can see it's a lot more calculation. And that -1 is your geometric. Which number will always be higher, arithmetic or geometric? Arithmetic will always be higher. Could be equal, but it can't be lower. It's impossible mathematically. So arithmetic always has to be higher. And why is that? Because of standard deviation. And I'll show you here in a second why that is the case. All right, let's try it. So for Walmart, the arithmetic average, this is a monthly average. It's real straightforward. We just take 0.0861 plus 0.008 minus 0.0215, divide by 3, we get 2.42%. How could I do that in Excel? Pretty straightforward. It's just average. In Excel, equal average, you just link them and 2.42%. There's their arithmetic average. What about NVIDIA? 0.1982 minus 0.619 minus 0.955 divided by 3. Oops, I could tell something was off there. Their average is negative 5.54. Whoa. Now, on the exam, I strongly recommend you convert all percents into integers. Just getting to have, I have students that on the geometric link will forget the percents. Instead of using 19.82%, they're actually using 1900.82%. You know, some massive numbers. So anytime you see a percent, just automatically think 0.1982 minus 0.00215. Always convert everything to percents. Especially with geometric, it makes a big difference. You've got to get the percent exactly right. So make sure you do that. All right. How do we annualize this? We just take that arithmetic and multiply by 12 because there's 12 months in a year. Pretty simple. Now you have to put a footnote on the exam. Why do you have to put a footnote on an exam? Well, you can annualize returns for the CFA Institute. They allow you to do it, but only if you have at least 12 months of data. You can't annualize 3 months of data. Now, if you go on Bloomberg machines and use their return function, if you look at 3 months, they do annualize 3 months. I didn't put it on that Excel spreadsheet I built for paper 2. I left the annualized off just to keep it from being confusing. They do annualize, but you shouldn't if you have fewer than 3 months. So on the exam, I'm only going to give you 3 months. You do all the calculations. When you annualize it, I want you to put a footnote and say, oh, by the way, the CFA Institute does not allow you to annualize any period less than a year. If you had 13 months, we could take an average of the 13 months, you add up the 13 months, divide by 13, that you can multiply by 12, and that you could report in your performance numbers. I mean, do either of these numbers really tell you anything? How many of y'all think their annual return on NVIDIA stocks can be negative 67% the next 50 years? Is that your forecast? Or that Walmart's stock's going to return 29% the next 50 years? Probably not a very useful number. But if I had NVIDIA for the last 40 years or 30 years, however long they've existed, that might tell you more information. Annualizing that might help you. All right, there's arithmetic. Now let's try geometric. And I don't understand the, it's arithmetic, I think. Is it arithmetric? I think it's arithmetic, but it's geometric, I think. Someone can Google that for me, but I think the arithmetic doesn't have an R at the end and the geometric does, but I don't know why. So the geometric monthly average. So this is a lot of work on the exam. You have to do it essentially by hand, but you take the 1 plus the first month, 0.0861. See how important it is, convert that to decimals, times 1 plus the second month, 0.008, times 1 plus the third month, which is negative 215. You're going to take all of that, and I recommend be real careful on the exam. If you're using a calculator, you need to practice this over and over and over again so you get really good at it. Because if you just do the raised to the 1 divided by n there, you got to be real careful. Is your calculator only raising this last one to the third, or is it raising that whole thing? So you got to make sure the raise to the time is after all of that. You got to multiply all that together, get a number, and then you raise it to the 1 divided by n. Here we have 3 months. So we raise it to the 1 divided by 3 minus 1. And that's going to give us our number. So it has to be less than 242. So that somewhat tells you if you got the right answer or not. So if you get geometric at 23%, you know you did something wrong. Or 1 or 2 is wrong. Huh? No, it's by hand. So you have to do it. But that's why I only give you 3 months. Yeah, I'd love to. I do. I think I did in y'all's class, didn't I? But your class was small. It's just no way I can. I wish UTSA had a room where they had computers where you could use Excel and does not access other things, but we don't have that ability. I don't know if any school does. All right, so there's your geometrically linked. It has to be lower than arithmetic. So when we do, so you start off with 2 parentheses, 1 plus 0.1982 times 1 minus 0.169 times 1 minus 0.1955, close parentheses twice, raise that to 1 divided by 3 minus 1. Now, that one's also going to be smaller than arithmetic. So when you have a negative number, it's just going to be more negative. So it always has to be smaller. What about annualized? Well, here it's the exact same formula. Just one little change. It's that one little change. Anybody remember or know? This first part's exactly the same. It's the only change we need to make to annualize this. All right, so we're going to raise it not to the 1/3, but to the 12/3. If you're doing weekly, what would we raise it to? 52 over 3. If you did 3 weeks, you have 52 over 3. Right? So you do it to the 12/3. Now here you can get a higher number. So when you annualize it, it's possible for the annualized geometric to be higher than annualized arithmetic. But when you're looking at the monthly, it has to be lower. Okay, so remember that. Don't freak out that the annualized geo is higher than annualized arithmetic. That's perfectly fine. So Make sure you're practicing this with your calculators. I hate calculators. I'd rather Jaden do it in Excel if we could, because that's what you're going to do in real life. But make sure you can do it in your calculator with the right parentheses and all that kind of stuff. I don't think your calculators actually have that function. One thing on the exam though is you write out all your work. When we do the bond pricing, your Excel, your calculator does have the formula for bonds, and you can use it to check your work, but you still have to show all your work. So you still have to do it my way, whether you want to or not. So you still have to do it my way, but then you can check it using a calculator, which is fine. I don't mind you doing that as long as you write it out the longhand. If you don't show your work and you get the exact right answer, you get 0 credit. If you show your work and you get a horribly wrong answer, but it's because of a math error, you could get full credits. So I'm more interested that you know how to do it than you make a typo in here. So you accidentally key 0.512 instead of 0.215. I'd probably give you full credit because I see it right there. You wrote it and you just hit the wrong button. So that's not a big deal. So I'm more interested you know how to do it. Same thing here for NVIDIA, we rise it to the 12th. Now there you can see it's greater as well. So when you annualize it, you'll often get a bigger number geometric than arithmetic, but you can't when you do the monthly. All right, so next week we'll do a team competition. I'll give you the exact exam question. I'll probably do the same thing we did last time. If y'all do well on it, we'll only do one of them. If you don't do well on it, we'll have to do another one. Make sure you know how to do these. So someone on your team, make sure you have it down. All right, so what can we do with this information? So first of all, why is the geometric and arithmetic different? So let's look at that. You'll find out why we prefer the geometric. Let's say your uncle, we've been talking about your uncle here, and he gives you $100,000. Times 0, you got $100,000. At time 1, your uncle checks in, you got 150,000 bucks. Your uncle said, wow, really know your finance. I'm glad I gave you the money. Time 2, you have $75,000. Now what is your uncle saying? Wait, why didn't you just go to cash in the first year? I have 150,000. So what is your holding period return? So we take ending market value minus beginning market value plus income divided by beginning market value. We made a 50% return. Second period, we take ending market value minus beginning market value plus a 0 divided by beginning. We lost 50%. All right, so you call your uncle and say, I just calculated your average return. I take 0.5 minus 0.5 divided by 2. And uncle, you made on average 0%. What is your uncle telling you? Say, I started with 100,000. I have 75,000. Yeah, but she made on average 0%. Is he going to buy that? Not going to buy that. Let's do the geometric. So here we take 1 plus 0.5 times 1 plus negative 0.5, raise it to the 1 divided by 2 minus 1. He lost on average 13.4%. Would he buy that number? That may make sense. What does that 13.14 tell you? What it's saying, if you start with 100,000 and you lose exactly 13.4, and then the next month you lose exactly 13.4, what do you think you're going to end up with? Exactly 75. Which of these numbers are you going to believe? The negative 13. Which do we publish in our official returns? The 0. Why is that? Because your uncle could have giving you a lot more money here or whatever. And this is the number we do these time-weighted returns. So yeah, it's just geometric is your true return. That's why I use geometric when I'm assessing my portfolio. I want to know what my true return is. What return do I need that gets me from my starting value to my ending value, including the timing of my cash flows. If I was really stupid and put a whole bunch of money in at the wrong time, I want to see that harm in my return. So why are these so different? Well, because when you have a high standard deviation, that standard deviation is going to impact the GO more. Why? Because a 50% rise is 50,000, but a 50% drop is 75,000. So the gains aren't as big dollar wise as the losses, and that's just the nature of this. Or you could do it the other way. He could have gone from a 100 to 50, and then from 50 to 75. The loss lost you 50,000. The gain only got you 25 back. So if you lose 50%, how much do you have to make to get back to where you were? You have to make 100%. So that's why, because your divisor is smaller, because you lost money. So you got to make more to get back to where you were. You can't just make 50% because you only have half as much. Same thing, if you make the gain first, then when you lose money, it's a bigger dollar amount because you're losing off of a bigger number. So that's why arithmetic gives you a better number all the time. All right, so there's your returns. We'll practice that some with some team exercises. Let's talk about risk, my favorite topic. I teach risk management in the spring. It's my favorite class. I doubt it's my students' favorite class because there's a couple of tough projects in there, especially the first project. But boys, I remember a lady from Goldman Sachs, when she interviewed people, she asked if they'd taken that risk management class because it's like, that's what they do. That was really hitting right center to what they were doing. But risk, extremely important number. There's 4 formulas you should know, and then net on second off the top of your head. Standard deviation, beta, correlation, and R squared. You shouldn't have to look them up. You should just know them off the top of your head without even checking. Now, you did these in your stats class. Is it, anybody remember these formulas? How many of y'all could write these down right now? Anybody? It's got to be at least 1 or 2 in here. All right, so we'll talk about it. I think I got at least 1 promotion because I knew these formulas, because no one else knew them. And it was like, you know off the top of your head. Why is it so important? Because there's an incredible amount of theory in these formulas. And if you're going to apply these formulas to finance, you better know the underlying theory, because there's times when these formulas absolutely do not work. If you don't know that, then you're maybe applying these at the worst possible time and making some errors. So let's try it. So let's try it with, let's see if I have enough time. I'll probably do this twice. Let's do this with NVIDIA. Let's bring in monthly data back as far as we can go. How far back? 1999. That's pretty good. So I'm going to download that. Now, one thing you'll notice when I download it, that the dividends disappear, but they don't really disappear. You see this adjusted close? You're going to use the adjusted close on paper 3. The adjusted close, what they do there for you is they adjust for that dividend. So what they do is to say, if it pays a dividend, it assumes you take that dividend, you buy 4 cents worth of NVIDIA stock. So essentially it's back in there. So that's the right number to use. So we're going to use the adjusted close. There's NVIDIA, and all we need is that adjusted close. And then I'm going to bring the stock market in here as well. You'll notice with the S&P 500 index, the adjusted close and the close are the same. And why is that? Because this is a price only index, which is fine for what we need to do. It's a price only index. We're going to do monthly back to whenever. I'll do max, but what did we say we needed? Back to February 1999. Now, unfortunately, Yahoo took the download button off. I don't know why they did that, just to irritate me, I think, more than anything else. But we're going to go back to, and I already forgot what I just said. What did we say, 1999? Was it January? I mean, February. So let's go back. do. I'll do January just in case. We'll use adjusted close, but it doesn't matter for the index. It's the same. So we needed to start from 2. February, are we lined up? September, got it. I'm not going to use October because October's not over yet. So I got my data. There's NVIDIA. There's the S&P 500. Why do I need the S&P 500? What might I use that for? I want to get the return for NVIDIA, but what else might I want for NVIDIA? Correlation, you need 2 things for correlation. What else? Beta, what else? R squared. So 3 of them, you need 2 of them, but for one of them, you only need 1. So what we're going to do, now what I'm doing here is I highly recommend that you be able to do this with a blank Excel spreadsheet. Everything I just did without looking at anything. Off the top of your head, you can do everything I'm doing right here. How many tries will it take you? I don't know, but you should, before you graduate, be able to do this entirely off the top of your head. So the first thing we're going to do, we're going to do the holding period return for NVIDIA. We're going to do the holding period return for S&P 500. I can't do January, right? Why can't I do, I can't do February. Why can't I do February? Yeah, I don't have beginning price. So I have to start in March. And we don't have dividends, but that's already included in the adjusted close. So we already have that. So all we need to do in the formula is we're just going to do ending market value minus beginning market value plus 0. I don't have to put that in there, but plus 0 divided by beginning market value. So there's their return. And there's the S&P's return. So I now have 283 months of data. Can I annualize this average return? I can, right? So what are we going to do? So we got NVIDIA, we got S&P 500. Let's get arithmetic. Arithmetic average. Now, you know what that is, right? It's just the sum of the returns divided by n. So we know what that is. So there's that number. If Bill Gates would let me actually do it. Whoa, Bill Gates. Why in the world would you think I would want that many decimal places? So 354, how else can you do it? You can just use the average function. So 3.54. All right, so that's their monthly average. Is that a high number or a low average, a monthly number? Does that sound good or sound weak? So let's annualize it, and what do we get? How do we annualize this number from arithmetic? Just multiply by 12. Right? Does that sound like a good number? 42%? Sounds pretty good to me. Can we use that number? Yeah, that's allowed. Why? Because there's more than 3 months here. We can do the exact same thing for the S&P 500. Its that monthly average is only 0.48%. Wait, okay. Does that make sense? Yeah, because we don't expect stocks to make 1% a month. So that average is 5.7. Now that sounds really low. Why does it sound really low? Well, because it doesn't have dividends in it. Dividends adds another 2%. So the stock market's made about 8% if you add the dividends in. All right, for our purposes, that's not important for calculating beta and those kind of things. All right, let's do the geometric. So here's the thing where I can't get the geometric without doing it by hand unless someone figures this out. However, I'll give you a little trick. The geometric average here if there is no income, it's really easy. You just take ending value divided by beginning value raised to the 1 over n minus 1. All right. See if I can show you in the other spreadsheet. I take 75,000 divided by 100,000 raised to the 1 divided by 2 minus 1. What do I get? The exact same number. All right. So if there's no income, we can just take the ending value over the beginning. And we've got it. If we have income, we have to make all those adjustments, but that's adjusted close already does that for us. All right. So what could we do for NVIDIA then? You can do equal the ending value, 121.35 divided by the beginning value, 42 cents, raised to the 1 divided by the number of months. Now the number of months, you don't count the beginning one. So the beginning one's not in your count. So we go after that, minus 1. And I have parentheses problems somewhere. Yeah, Bill Gates doesn't understand geometric numbers. So you notice the minus 1 has to be after the entire formula. So you take beginning divided by beginning, 1 over the count, and that whole thing is minus 1. Now we know it has to be less than what? It has to be less than 354. So if I get 4 something, I made a mistake. And what do I get? I get 2.02. Is that correct? We'll check it here in a second. Same thing on the S&P 500. Does that one look like it could be right? Arithmetic was 48. Geometric was 38. So that looks very possible. Right? Y'all see that ending over beginning saves us a lot of time. Otherwise, I'd have to take 1 plus that times 1 plus that plus 1 plus that, link it all together, and that would take me a lot of time. So all right, let's annualize the geometric. So it's the same formula again, isn't it? That's the only change I need to make here. Just one little change. It's monthly data. How many months in a year? 12. So where do I make that adjustment? You don't have many choices. Do I subtract 12 or do I raise it to the 12 over count? Right there, right? Now that one can be higher than 42%. So here it's not, but it can be. All right. So you got to watch that. And there's the S&P. Now something I'll show you in the notes that we can try. I think I put it down here. I'll tell you here somewhere. Yeah, I thought I had it in the notes, but maybe I don't. Well, we'll try it next week, next class then if I can. I put it in the notes, but I don't have it in my shortened notes here. All right. So there's my arithmetic, my geometric averages. All right, so let's talk these other things. We got standard deviation, correlation, R squared, Why is it R squared? Because it's correlation is rho squared is R squared. So correlation R squared go together. Then we have beta. All right, so let's look at these formulas and see if I can get it so that today you can leave where you know these formulas for the rest of your life. All four of these formulas start with the exact same thing. And you may remember what's the first thing you always do. We've got the average, so we're going to need that. So where do you start with all these functions? You remember this, you have the sum sign, and then what did you do first? Do I remember this? X I minus what? X bar. Does that sound familiar? What is xi minus x bar? Each month's return minus what? X bar is what? The arithmetic average. All right, so we'll do that for NVIDIA. We'll do that for the S&P. So let's start right there. So we have negative 3.77% minus our geometric average. I'm sorry?
Arithmetic.
Or arithmetic. Oh, did I do geometric? Yeah, sorry, arithmetic. Thanks. Yeah, arithmetic. All right, so why is this so critical? This tells you like 90% of finance right there. How does finance define risk? We define risk for how far can you get from the expected value. If something's low risk, why is it low risk? Because if we think it's going to make 5%, it's going to make 5% or really close. It's not going to make 47% or negative 32%. It's going to make 4.8% or 5.2%. If we think something's going to make 5%, but it could make 82% or negative 72%, that's a lot of risk. So we define risk in finance as how far you can get from the expected value. We don't talk about skewing here. Skewing is pretty important, right? What if you had an asset that's 5%, 4.8, 5.2, 4.9, 5.3? That sounds pretty low risk. Every once in a while, it's negative 42 million %. Would you want to know that? So most of the time, it's really narrow, and then every once in a while, you lose everything. That would be pretty bad. So we're ignoring that. What are we assuming is standard deviation? What kind of distribution? Normal distribution, everything's nice and symmetrical. So if that's not true, which is probably not true for NVIDIA, that could be an issue. All right, so we can copy that down. We can do the same thing for the S&P 500. So 3.88% minus 0.48%. So there we have the S&P, right? The 388 for the S&P minus its average. Copy that down. So all four of these formulas start with xi minus x bar. So that idea of how far you can get from expected value dominates our statistics in finance. So what do we do next? So the first step one is the difference from the average. So the first thing you do is you take a difference, minus. The second thing you're going to do is you're going to multiply. All right. If you have two numbers, you multiply them against each other. If you have one number, you multiply it against itself. So for NVIDIA, so we're going to need a couple more columns here. Is this coming back to you? So the difference squared. So difference squared, we take the negative 7.24 times, and that's what we do with standard deviation. You square the differences of the S&P, of the NVIDIA and the S&P. What happens when you square numbers? Two things happen. So this was a negative 3.7%. What is it now? It's now positive 0.52. So what does standard deviation tell you? We don't care if you're above the mean or below the mean. All we care about is the difference. So that's the first thing. You don't get any negative numbers. I don't know if that y'all covered semi-variance in your stats class, but standard deviation, it says a normal curve. Hey, you can try this with your uncle. Hey, I have this asset class. It's really, really volatile. We expect to make 8%, but last month it made 42%. He might say, that doesn't sound like risk to me. You expected 8 and you made 42. That sounds like a good thing. But why is that? Why do we call that risk? If you expect 8, you make 42%. What else could happen? You expect 8, you will lose 30-something%. So from us, we say, hey, if you could be way above the average, you could probably be way below the average. So we don't care if you're above or below. Semi-variance only looks at your standard deviation or your volatility when you're below average. It ignores the above average. So that's semi-variance. There is some debate. I can't say this for sure. I've read it in textbooks. And when Markowitz set up his model, he wanted to use semi-variance, but the math was too hard because they didn't have computers and calculators. So he used standard deviation because it was easier math. So that certainly is possible. All right, so we're going to just take those squared differences. And what's the other thing you do? The differences by each other. So here, what do? We're looking at the difference for NVIDIA times the difference for S&P. What is that for? That's for correlation R squared and beta. Correlation R squared and beta, you have two asset classes. So there you take the difference and you multiply them by each other. Y'all see the difference? Standard deviation, you only have one asset class. You take the difference, you square it, whether it's S&P or NVIDIA. When you have NVIDIA and, where's my ampersand? The S&P, then you multiply the two differences by each other. We take that down. But the formulas still look really similar, right? You subtract first and then you multiply. What's the next thing you do? Pretty easy. Take the average. That's pretty easy, isn't it? So we just take the averages of these. Equal average. Or average equal average. Just take the average. And then what's the last thing you do? It depends. They're all a little different. So for standard deviation, we take the average of the square differences and raise it 0.5. So for standard deviation, you just take the square root of what? What was this number here? That's volatility. So standard deviation is the square root of volatility. Did I do it right? I don't know. We'll see. I'll let Bill Gates check for me. Does it look close? Does that look pretty close? All right, so there's the formula in Excel, STDEVP. Why did I put the P on there? Because I'm using the population. It's all the data I have, so it's population. So how did I get this 17.87? Can anyone walk me through it without looking? Step one was what? Xi minus X bar. Second step, square it. Third step. Well, the first was the difference. Second, you square it. Third, take the average, and then what? Take the square root of that. Fairly simple, isn't it? All right. What about correlation then? Okay, well, correlation, we have the averages of the differences. That's actually got a name. Anybody know the name of that? Starts with a C, but it's not correlation. What do we call this? Variance. What do we call this? You remember covariance? So the average of those multiplied differences, that's covariance. What is correlation? Correlation is covariance divided by the standard deviation of each thing. So it's covariance over the standard deviation of NVIDIA times the standard deviation of S&P. Is any of this coming back to y'all at all? Starting to sound familiar, right? 0.5. Let's see if that's right. Y'all think I got that right? Y'all think, well, of course he did, but I actually don't have that much confidence. I usually mess something up. So the covariance correlation of that versus that. How close did I get? Does that look pretty close? Looks pretty good, doesn't it? All right. Again, how do I do that? Difference of NVIDIA from its mean, difference of S&P. I'll multiply them, take the average of that. That's my covariance. Divide that by the standard deviation of the S&P and the standard deviation of NVIDIA. What is R squared? That's the easiest one of all. R squared is R squared. So that's pretty straightforward. Now this one we can check, but I don't know why we would, but R squared. If you want to do it. That looked pretty close. It's just, if you get correlation R squared, it's fairly straightforward. And then we have betas. I bet no one remembers beta, but beta and correlation are almost the exact same formula. They both have covariance in the numerator. They both have standard deviation twice in the numerator, in the denominator, but what's the only difference? Anybody remember beta? Did they do beta in stats? Because sometimes they don't do beta in stats, because that's kind of a finance thing. Anybody know? What's the difference between now? What's the highest correlation can possibly be? 1. What's the lowest it can possibly be? -1. What's the highest beta can be? 87 trillion to the 87 trillionth power. There is no limit. So why is that? It's almost the exact same formula. There's only one difference. Beta is measuring systematic risk. Another word for systematic risk is market risk. Which of these two, NVIDIA or S&P, is the market? S&P. So we don't want NVIDIA's risk in there. We only want the S&P 500's risk. So how do we do beta? Beta is the covariance divided by the standard deviation of the S&P times the standard deviation of the S&P. Almost the exact same formula we just did. And when you do that, you get 2.03. Now I can check this one. The way you check this is you do slope, but you have to be very careful. You're going to use slope on paper 3, but it's extremely important that you do your company first, then the market, or you'll get a strange answer. Why? Because it has to know which standard deviation to divide by. So it's the second one. So how close did I get? That looked pretty close. Pretty close, right? If I switch these two, it's really wild looking number. All right. Y'all see what I did? I did it by hand, calculated thing by hand, and I checked it with Bill Gates. If you can do this with a blank spreadsheet, then you understand this stuff. If you can't, I don't think you do understand. So you got to get to this level of understanding so that you have a huge advantage over your competitors. We'll look at this a little bit more. I'll save this up. All right, I'll stop there. Pretty amazing days. So when we look at it, I will add Facebook to the file. I have to wait until after market close because I can get the return. But that's pretty amazing. This to me is the most shocking. We talked about growth and value stocks. That's a value stock. 7.69. That's the company that they think their earnings going to be falling pretty dramatically next few years. I'm interested in Facebook because they're either going to fail miserably, or if they get it together, it's either going to soar up hundreds of percents, or it's just going to kind of die out a slow death. Pretty amazing. Now, did they miss like by a massive amount? You got plenty of discussions here. Part of it's what they're trying to create. They're spending a lot of money trying to create a whole new business model. They're losing their advertising business, but so is Google, and YouTube's suffering as well. We saw that. I put Google in the file, but I don't know if they say the numbers in here. They weren't massive misses at all. They just won't tell me the numbers here. Yeah, sorry. So they announced last night, so we had to look at Wednesday. So they missed 12%, 164 versus 188, but that's not why it's selling off so much. Yeah, that's a pretty huge drop. What's the other thing is it's down so much from last year. We don't have third quarter in here, but just they've dropped so much in earnings. I don't know if they show revenue in here. They should. So yeah, so that's an interesting to talk about. There'll be plenty of articles on it, so it should be interesting. The other one I might add, we'll see. It didn't look. It kind of seems boring because of Meta, but McDonald's, they're up 3.7%. And the big thing on McDonald's is they're able to pass their costs on their customers. I don't know if y'all don't eat at McDonald's, right? But if you did, is it more expensive to eat there noticeably? You might notice. So you have to ask people that do. But somehow they're able to pass those costs on. That's good. I found an article which might affect whatever company you pick, talking about how the strong US dollar is really harming earnings this year. So that might be an angle to take. For two reasons. First, their overseas business, when they convert back to US dollars, they lose money. The other thing is whatever they sell overseas is going to be more expensive because they make it in US dollars. So it's a double hit. So you'll see that a lot where strong US dollars hurting earnings, weak US dollars helping earnings. So right now we have a fairly radical US dollar. And so that should be in the numbers. Although I think both the pound and the euro, no, the euro's back below 1. The pound has recovered. I love the articles that say the pound fell down to 1, but it's recovered slightly. That's a 15% recovery. That doesn't seem slight to me. That's a pretty dramatic recovery in the pound. Is because of their new prime minister or whatever. Who knows what they're reacting to. So anyway, there's plenty of talk. Have you picked your company yet? Are y'all waiting for me to put Meta out there? Meta's going to be the more exciting one to talk about. You can have plenty of stuff to talk about there. McDonald's kind of boring company, but definitely had a good earnings report. So inflation will maybe be part of almost all discussions. Certainly supply chain issues can be part of it. Where do you see inflation? That gross margin becomes really important, doesn't it? If their cost of goods sold is going up, can they raise their prices to keep that margin stable? The US dollar, if they have an overseas operations, would be important. Ukrainian war might be an issue. I don't know how much McDonald's lost by shutting down in Russia. Probably not that material to their overall. So I don't know. Who has picked their company? So Mark, you want to tell us, or it's
Constellation Brands.
Constellation? All right. That's one of the ones I gave you out too, isn't it? So there's a lot to talk about there. Yeah, they're doing some interesting things. I don't know how far they are on the cannabis thing. That would be interesting to see what states they're in there. All right, so you've got next week, is when you have to write it. It's due next Friday. So I'm hoping someone will have a draft paper that we can look at. If not, I'll show you a previous class's paper. All right. Borna will show me a new formula. I haven't used this formula before, geomean. It's interesting. I can't get it to work in my file for some reason, but I'll try again. So Geo, you tell me what I'm doing wrong. So here's NVIDIA 202. So equal geo mean, and you don't do the returns. You actually do that. Now I notice you started with the second one. So I'm not sure exactly how you got the same answer when you started with this one instead of that one. And then -1, but it gives me a radically different answer. So maybe, I think I sent you this file, right?
Yeah, you send this.
You can see if you can get it to work. I can't get
What they
to.
had to do individually was, so each earning, with a geomean mathematical, formula, we have to add one to each
Right.
earning, and then also continue the formula. With this geomean formula, the Excel formula, we have to, what I did, I added a column, you can see at the B5.
Right. That's
So I have
the,
to add that one to each one of those, and then.
well, that's what this column is. This is the one added to each one.
One added, okay.
It's essentially, because you know, this is the index.
True.
So yeah, I mean, so if I did one, added each one of these and started at 42 cents, I'd end up with 121.35. So we'll have to find a way. Hopefully there's a way to do it, but we'll see. I mean, on the exam, I want you to use the formula we've been using, which is each one times itself. Now I use the ending value divided by beginning value raised to that. I mean, that's the easiest way to do it. So you essentially create an index and you just do out the math. You'll use this formula a lot in your career. Ending value over beginning value raised to 1 over the number of periods minus 1. That's very popular. I wish I had an actual count. It's for my career. It has to be in the millions, tens of millions, because we have spreadsheets that are just massive and we're calculating that thing just thousands of times. So it's a pretty common, because you want to know your return. All right, one last thing I was going to show you is this formula here. Why is the arithmetic average always higher than the geometric? And it's because if you have a normal distribution, the geometric average should equal about the arithmetic minus half the volatility. Let's see if that works with NVIDIA. The arithmetic was 354, the geometric was that, so we'll take arithmetic minus 0.5 times the standard deviation squared. So how close did it get? 194 versus 202. It's pretty close. We can try that with the S&P. That one, it's right on. 38 versus 38. So maybe NVIDIA is not normally distributed. Maybe it's a little skewed left or right, and the S&P is right on. So, but that is one way you can tell if a database is normally distributed or not. This formula doesn't give you a close number. There's some skewing on the positive or negative, and it can certainly highlight that. So, but that's the key. Geometric always has to be lower, because obviously standard deviation can't be negative. It always has to be positive. So you're taking arithmetic mass minus half the volatility square. And that's why volatility is so important. If you have low volatility, the geometric and the arithmetic will be almost the same number. If you have high volatility, they can be really, really different, which means you're somewhat kidding yourself saying, wow, I'm making 354. Well, that's the mean, but your true return is only 2%. It's quite significantly lower because those losses hurt you a whole lot more than the gains help you. All right, let's jump back to these. Does anyone here know these 4 formulas off the top of their heads? Did we get it last week? Step 1 is what? Add, subtract, multiply, divide. What do you do? Step 1. And y'all got to know this stuff.
Okay.
Subtract xi minus x bar. So remember, the whole of finance is in that one thing. How far can you get from the average? What else do we call the average? You remember in your stats class or in finance, what we call it? You ever heard the expected value? Do we really expect it? If the S&P 500 has an arithmetic average of 8%, do we expect it to make 8% next year? When do you expect the S&P to make exactly 8%? Maybe never. But we use the word expected value just to kind of tell us what's in the middle. So we start off, all of our finance risk is how far something can get from that expected value. The further away you can get, the more risky is it. All right, so you start with subtraction, then you do what? Multiply, divide, add, multiply. On standard deviation, you just square it. On correlation, you're taking the two data and multiplying them. All right, step 3. So you take the difference, you then multiply, and then what do? You have all these differences, what do? Take the average of all those differences. And then the last step, you got to, standard deviation, you take the square root, correlation, you take the covariance, right? The average of all those differences times each other. That's the covariance. Covariance divided by the standard deviation of the two pieces. Really critical. So if you think about correlation, pretty important one. What we're saying with correlation, so here's the xi minus x bar. So there it is for NVIDIA. On that first month, they made negative 3.7, negative 3.7 minus the average gave you negative 7. S&P, their average was 0.38%, so they made 3.88 minus 0.3. So what you're looking at with correlation is you have a negative number and a positive number. So that's going to give you a negative number there. Same thing here. Here you have two negative numbers, so that's going to give you a positive number. So what correlation is looking at, I think is really critical, is not how these move together. It's looking at how they move relative to their averages versus each other. Are they both above their average at the same time or below their average at the same time? So you can see NVIDIA started off well below average when the S&P was above. Second month as well. Then they're both below average, then they're both above average. There you can see NVIDIA is way above average. S&P was below, but then they're both below. That's what correlation is looking at. Because they're always above at the same time, always below at the same time, you get nothing but positive numbers. If one's always above when the other one's below, then you're going to get a negative correlation. All right, so you can kind of look through the numbers and get a little bit of a sense of it. There, my word. That probably would influence your correlation somewhat just that 1 year. Kind of all over the place. And then, I don't know, 2000 obviously was the end of the crisis. Are getting into the .com crisis. So I mean, there's there's some negative months. That's kind of like that looks like here recently, doesn't it? What I've done here recently. Wow, 35%. So I mean, that looks bad, 23%, but that was 1 month, which is about what Meta's losing today. So maybe it's not all that big. All right, so you get a sense of correlation. Beta is the same thing. Right, because beta is exactly the same as a correlation, except you divide by the market's risk, not this individual stock. So all three of those are really looking at how do these move relative to their averages. So they're generally above at the same time or generally below at the same time. So it doesn't just say are they both positive at the same time, because NVIDIA could be positive. 1% would be a positive return. But when you take 1% minus the 3% average, you get a negative. So it's not whether their returns are positive or negative together, it's whether they're above or below their averages at the same time. So I think that's pretty critical in the analysis as well, especially if you're using annual data. Right. I would know these formulas top of your head and then nano, so you wouldn't even have to even think about it. So that spreadsheet I did last class, you should, with a blank spreadsheet, you should be able to create that whole thing on your own, and maybe Barna will show you how to check the geo. We use these a lot. Standard deviation is one of our main measures of risk. We're going to use beta here quite a bit, especially in paper 3. And we do use correlation R squared quite a bit. Correlation when used when we're building efficient frontiers is an important input there, as well as standard deviation. And then R squared we use a lot. You saw that when we talked about style analysis, trying to explain how much risk you've got covered. So we use these tremendously. Now, what did y'all do in your stats class with these? You didn't do beta at all in your stats class, did you? Completely ignored it. Did y'all have some good projects with standard deviation, correlation, R squared? I'm not a stats person. I'd love to teach a stats class though, because boy, there's so much you can do with this stuff. But it was taught in the math department, right? And they're showing this stuff with R squareds of 98% and everything works out. And then you get the finance and you're lucky to get an R squared of 23%. You're like, what do I do with that? It's just a lot tougher in finance to get good correlations. All right, so what can we do with all of this? So here's the formulas. Why are these formulas so important? Because the theories of finance are reflected in our formulas. So I'm going to argue if you don't know the formula, you don't know finance, because that's how we capture it. To me, formulas are our anatomy. So if I find someone who doesn't know formulas, it's like walking to the doctor's office. I got a pain in my side, doctor. Could be an appendicitis, and the doctor pulls out the anatomy book and says, yeah, let me see what side the appendix is on. What would be your next step? I'd be running out of the room. That's like a finance person who doesn't know standard deviation off the top of their head. It's like, how can you be a finance major and not know this core measure for finance? All right, so we've done all of this. You should just know all this off the top of your head. All right, so when do we use standard deviation? When do you use beta? When do you use correlation? That's really, really important. So standard deviation is often referred to as total risk. So we use standard deviation when we're looking at everything. You're looking at your entire portfolio. Standard deviation is the right measure because it's everything you got. So we calculate a standard deviation of the stock, your stock portfolio. Let's say you have $1 million stock portfolio. You have its returns the last 20 years. You can say, hey, what's the standard deviation of my stock portfolio? And that would tell you your total risk. And you can compare that to other people's portfolios. Say, well, my standard deviation is 12%, yours is 10. I have a riskier portfolio than you. Standard deviation, ask how far can you get from the mean or the expected value. It ignores whether you're above or below. It's just looking how far can you get from that expected value. And it ignores outliers. So if you have an extreme outlier, you got to decide what to do with it. People are asking about 2008. That was an outlier, really big down year. So some people say, well, take it out because that'll never happen again. Some people say, yeah, it could happen again. That tells us a lot about risk. We need to have that in our numbers. Why would you take it out? Because we're trying to sell a product. We want a customer to buy it. Let's make the risk look smaller than it really is because maybe they buy the product, but who knows? You gotta decide what the true risk is. Was 2008 really, really unusual? Or could we see something like that? I like what Taleb says, the guy who wrote Black Swan. He says he thinks going forward, we're going to have these really calm periods and then a big crash, followed by a really calm period by a bigger crash, really calm period by even bigger crash. That's his idea. I think the one flaw with his idea is he's arguing that because we're becoming more global and more interconnected, and I think globalization is breaking down. So we may find that that's not so strong. I mean, China's now really slowing down. What happens when the second largest economy starts slowing down? I mean, their numbers are getting kind of scary. And I don't know if you saw last night, it was interesting. I like what was it Juan Carlos that showed that one chart with President Xi essentially getting rid of his pro-market people. That's not a good sign. So ignores above or below. It's sensitive to outliers. The other thing, it assumes normal distribution. So if you don't have something that's normally distributed, standard deviation is not a good measure. So if you got a bond portfolio, we can use standard deviations for bond portfolios, but they tend to be skewed because if you got a bond paying 5%, you're going to make 5%. Or you're going to lose 100%. It's not, if you have a bond paying 5%, you're not going to somehow make 30% on that bond. You're going to make 5% because that's what you're going to make. So it's skewed to the downside. So, not everything's normally distributed. The S&P 500 is fairly normally distributed, though it does have a little bit more on the negative side than it should. So it's a little bit negatively skewed, but not dramatically. You saw that when I did the arithmetic minus half the volatility, it gave me the right numbers. So you're always aware of these kind of things. If you know the formula, you'll definitely see how outliers influence the formula. Because you're taking the difference and squaring it. When you square a percent, squaring 10% versus squaring 1%, you get a much different answer. The 10% really dominates. So you got to be careful of that. So that's standard deviation is total risk. William Sharp said standard deviation is incorrect when you're looking at individual stocks. You don't want to look at the standard deviation of individual stocks when you're trying to assess risk. And the reason he said that is his capital asset pricing model. The reason he said that is stocks, individual stocks have two risks: systematic and unsystematic risk. Your total portfolio is just systematic risk. Essentially, if it's well diversified, you just got market risk. But an individual stock like Meta. So today Meta's down 20 something %, but the stock market's up. Well, that's interesting. And McDonald's is up a bunch more than the stock market. So the stock market's a systematic risk, but Meta is today reacting to news only related to Meta, Facebook. Maybe Google's off today because of Meta, who knows? Maybe there's some there. So what William Sharp says is a stock has systematic risk. That's what beta is going to measure. And there's unsystematic risk. And what he says on unsystematic risk is unsystematic risk is really easy to get rid of and completely eliminate by just diversifying your portfolio. He didn't say you reduce it. It's like last night, I didn't know what the word alleviate means. Does alleviate mean reduce or eliminate? Do y'all know? It means reduce. It doesn't mean eliminate. All right. So he's not saying alleviates the risk. He's saying it completely goes away. Once you have about 20, 25 stocks, you have zero unsystematic risk in your portfolio. So what's the bold claim William Sharp makes? The stock market will not pay you for taking unsystematic risk because you shouldn't have it anyway. You can take it if you want to, but you better know what you're doing because you're not going to get paid for taking that risk. So if you had your entire portfolio in Meta, you're going to be pretty upset today. But if you had a well-diversified portfolio, you'd probably be positive today. And the market's saying, yeah, we're not going to compensate you for having all your money in Meta. You should have had a well-diversified portfolio. Now, the CEO, Zuckerberg, he probably lost a lot of money today. He doesn't have a well-diversified exposure to Meta. He has a huge exposure to Meta, but he has no choice. He can't get around that. So he's kind of stuck with it. But it can be easily eliminated via diversification. You just add more stocks. Now, how much risk of a stock is systematic versus unsystematic? Let me show you some magic here. Here's NVIDIA. How do we figure out how much of NVIDIA's standard deviation is systematic and unsystematic? And the number sitting right there on the page. Anybody see it? Any guesses? What percentage of NVIDIA's standard deviation is systematic risk? It's on that page. Any guesses? Huh? No, not 2.03%, but you're looking in the right area. It is one of these numbers. So how much of this standard deviation is systematic risk and how much is it is unsystematic risk? 25%. That's what the R squared is telling you. When you calculate the R squared of a stock versus the market, that tells you how much of the risk is standard deviation. So how much of NVIDIA's risk is unsystematic, related only to NVIDIA? 75%. So if you can eliminate unsystematic risk easily, and unsystematic risk is 75% of the risk, you can easily eliminate 75% of the risk. Today is a good example. Meta's down 20 something %, but if you had 40 stocks in your portfolio, yeah, you'd have a little loss there, but others would not. You might have had McDonald's in there or whatever, something else. The market's up, so there's enough offsetting Meta, even though Meta is a really, really large stock. Oh, and this is pretty typical. I've got a blog on this. There's one major problem with this is during a time of a crisis like 2008, this R squared jumps pretty dramatically. So what that means is diversification works really well most of the time, except for when you really, really need it. So you got a well-diversified portfolio. Hey, I don't have to worry about Meta going down. I'm fine. And then 2008 comes around, everything falls a bunch. You're like, well, yeah, diversification really didn't help me. And that's pretty typical of finance. Our risk management tools work really well unless you need them, and then they don't work well at all. So yeah, these R squareds tend to be 15, 20, 25% for a typical stock, but then they will jump to 40, 50% during a major crisis. Now, COVID was a little different because you saw stocks like Carnival Cruise Line, United fall a bunch, but then you saw Zoom and Walmart and other stocks do really, really well. So even COVID, you did pretty well. 2008, Walmart did well in 08, but there weren't many stocks doing well in 08. We can look at FinViz and see. I love FinViz's chart. I don't know if y'all have used that chart. It's just such a wonderful chart. So today, boy, you can see Meta sitting there and Google's down too. Amazon's down a bunch. Microsoft is down. I put Microsoft out there yesterday, but you got a bunch that are up. Industrials are up. Banks, well, Visa, MasterCard should not be in financials, but banks are generally doing all right. Have y'all seen this thing when it's like all red, all green? But is it ever 100% red? I've never seen it 100% red. I've never seen it 100% green, and that's what the unsystematic risk is. And you can actually do this year to date. Year to date is pretty red, but Exxon's up. Why is Exxon up? Because oil prices are up. So even a year like this where it looks like everything's down, well, energy's doing great. How did energy do 2 years ago? Exxon was really, really red 2 years ago. So I don't know why Lily's up or Merck's up 28%. That's kind of strange. I think Exxon's the highest returning one out there. I don't think anyone else has done better. And they've done better than CVX. No, Conoco's actually higher than Exxon now. That's kind of interesting. But not everything's red, not everything's blue, green. And even though a lot is red, the green ones, it's not like they're up 1 or 2%, they're up 75%. So you do get a lot of benefit from diversification in your portfolio. And so NVIDIA, if you put NVIDIA into your portfolio, your risk is 17%, and that's on a monthly basis. Remember when we annualize risk? Anybody remember how we annualize risk? We don't multiply by 12, but by what? The square root of 12. So NVIDIA's standard deviation is 62%. That's really risky. If you use 62% then price NVIDIA, you probably get a price of like $2.13. So you got a stock that's trading for what, 120 bucks or something. So you call up your broker, hey, I want to buy NVIDIA. Next time it hits $2, let me know. And what's your broker likely to say? What do you mean $2? It's trading for $121. Oh no, I use my risk number. I use 60% from a risk number. And when I price it through my model, I got $2. You can't use 60%. How much of that 60% disappears when you put it in a well-diversified portfolio? 75%. When you do that, then you might get a value for them of $110 or $130. So that's what William Sharp is arguing. You can't use standard deviation for your discount to affect your discount rate, because a big chunk of that 69% is completely disappears just because you have a well-diversified portfolio. Now that's not true for the S&P. What's the R squared of the S&P to the S&P? 100%. So it's all systematic risk. So you use standard deviation to measure the risk of the S&P 500, but you don't use standard deviation to measure the risk for NVIDIA. Now we actually use standard deviation. One of the inputs to our models is the 90-day vol. 90-day vol is nothing more than the standard deviation of the stock price last 90 days. We use it in our models, but the theory says we should. But it is used by some people. All right.
So when you're talking about diversifying the portfolio and avoiding the risk, you're assuming that, like, let's say we have like 20 or 25 stocks in it, do they have to be weighted the same?
Well, you can calculate how much unsystematic risk you still have in the portfolio. You could certainly do that. You got to make sure they can't all be biotech stocks, because biotechs, they have unsystematic risk that's related to the company, but also related to the industry. So you need to be well diversified. You can't have 60% in one stock to do it. There's studies that show equal weight. Once you get to somewhere around 15 to 20 to 25 stocks, the undiversifiable risk or diversifiable risk completely goes away. But that changes over time too. So you can't always be sure. You could look at a portfolio and say, based on history, this is how much unsystematic risk I have left. But that's based on history. That could change tomorrow. So it's a moving number. These are all stats. So that's what William Sharp is arguing. Total risk of a stock has two components. If you're looking at your portfolio, your unsystematic risk should be pretty close to zero. So we'll just ignore that. And then we can use standard deviation as our measure. So there's not much left. But for individual stock, the bulk of the risk. I used to ask this all classes. I didn't put you all on the spot, but I would ask, how much of an NVIDIA stock is systematic versus unsystematic? And most students would say most of it's systematic. Because they think, wow, the market's up 3%, NVIDIA is going to be up a bunch. Or the market's down 3%, NVIDIA is going to be down. But no, actually only 25% of it is systematic. Most of it is unsystematic. And I didn't pick NVIDIA because it's special. That's true for most stocks. Most stocks, unsystematic risk is the majority of their risk. And so William Sharp came up with this model and said, hey, we need to eliminate unsystematic risk from our discount rate. We should only look at systematic risk. Then the question is, how do you measure systematic risk? And he came up with this concept of beta, which is just the slope of your stock relative to the market. What is that slope? Steeper the slope, the higher the risk, the lower the slope, the lower the risk. The beta of your portfolio is really easy. It's just the weighted average betas of your individual stocks. You can't do that with standard deviation. You can't take NVIDIA standard deviation and Meta's and McDonald's and Citibank, take their standard deviations, weight them, and get the standard deviation of the portfolio. That won't work because they're going to offset each other. And I'll show you all that. It may not be today, but I'll show you all that eventually. We might be able to. So he says the more appropriate measure is beta, and the beta of your portfolio is going to tell you whether you're being aggressive or being defensive. So if your beta is 1.2, what are you assuming is going to happen next? A recession or a strong recovery? 1.2, you want a strong recovery. What if your beta is 0.7? You're probably being defensive, right? So if your beta is 1, you're just right there with the market. So this portfolio has a beta of 1.2. It probably has some auto manufacturers, maybe some travel stocks. It's skewed. It doesn't have as much Walmart as it has Ford, so it's skewed. How do you get the beta of this portfolio down? Well, you sell high beta stocks and you buy low beta stocks. It's real simple. So beta is really, really simple. It's a lot like duration. Beta and duration. You want to know the duration of your bond portfolio? It's just a weighted average duration of the individual bonds. The beta of your stock portfolio is just a weighted average beta of the individual stocks. So it makes it real simple. So if you want to say, hey, my beta of my stock portfolio is too high, then you list your stocks from highest beta to the lowest, and you cut back on some of the highest, buy some of the lowest, and that would bring your beta down pretty quickly. We've already seen the formula. Y'all remember what the top is called? The numerator right there, covariance, right? So the top is covariance divided by the standard deviation market squared, or the volatility of the market. Or you can use a slope range. Just be real careful when you use slope. That range 1 has to be your stock and range 2 is the market. You'll do this on paper 3. I'm going to show you how I want you to do that. So for individual bonds, there is no beta for individual bonds. So we look at duration, convexity, credit ratings. Bonds are very different things. When I talk to bond people, they're using very, very different type of jargon. All right, so let's look at NVIDIA again. So we calculated their beta. And their beta is 2.03. That's a really high beta, right? That's a very cyclical stock. It's not a stock you want if we go into a recession. So very, very cyclical stock. But has their beta always been 2.03? So one thing we want to try is, and you're going to do this on paper 3, is a rolling beta. All right. And we're going to do it the way Yahoo Finance does it. And y'all did it in my class, right? Jacob and Josh. We did that same thing. So you've already got this down, but I'll make you do it again. Won't be too bad. So Yahoo Finance will give you a beta for NVIDIA. And there it is right there, 1.71. The 2 was the entire period of time. The 1 point, or back to 8, whatever we went back to. The 175 is what? The last 5 years using monthly data. Is that the right answer? Let's see. Let's try it. So I want you to do a rolling beta, 5-year monthly. Why not 3 years weekly? You could do that. That's what Yahoo Finance used to have. For some reason, they switched from 3-year weekly to 5-year monthly. Bloomberg, I don't know what Bloomberg has. You'd have to kind of look and see. Bloomberg will have a beta. They actually have an adjusted beta, which I don't think you should ever use. But everybody has their different period of time. So if we're going to do 5 years monthly, how many months do we want? 5 years is 60 months, isn't it? So we go down 60 months. There's our 60th month. So we're going to figure out what their beta was for 5 years ending February 2004. So we're going to do equal slope. And there's NVIDIA's returns. There's the S&P. Got to do NVIDIA first, then the S&P. And there's their beta. Wow, it was a lot higher back then. You can copy that down. And what's the last one? Remember what we saw in Yahoo Finance? 171. We have 172. It should be the exact same number. Could be off a little bit because they may have some of October in there. I don't know exactly how they do it, but it should be really close. So it gives you a check figure. I want to look at the median, the 90th percentile, and the 10th percentile. So the median is going to be equal percentile. You can't use the median function, but equal percentile, that whole area at 0.5%. So the median is 1.65. So 50% of the time the beta is above that, 50% below that. The 90th percentile is 3.45. That may be driven by the .com. They probably got really hit hard by the .com period of time. And then the bottom is 1.29. So you can see this is definitely above 1 stock. Definitely above 1. So let's copy that down and we'll do a little graph. This is a graph you have to build in paper 3. We'll do a little graph here. Do you see 2 companies there? Early and now. So I might actually say, hey, I'm going to take some of that out. That might be the 2000. Let's put some dates in here so we can actually see. Make sure when you do your graphs that you clean them up. We don't need days and months in there. So I like to just use year. Makes more sense. So on NVIDIA, I might say, you know what, I'm just going to start here. That's 2009. I'm just going to do from 2009 forward because this looks like a completely different company. And you can certainly do that. Just find a different period plot point. Let me. So I don't actually have the .com in here, but anyway, much higher. If it's 5 years, there's probably some .com in there. Go back 5 years, so 2000, 2001 in there. But since then, you can see it's been ranging between the median is kind of the upper end. They never have fallen. Their beta has never been below 1. That makes sense. NVIDIA is an expensive product, you know, semiconductors. It's going to higher end kind of things. Their beta has risen here recently. Part of that is probably just the fact that they've dropped so much when the stock market's dropping. So beta can be influenced by just pure coincidence. They just happen to drop a bunch when the market's dropping a bunch. Why did a beta jump up here? Who knows? That may be related to, I don't know. The tech stocks were obviously doing extremely well there. So what beta would you use to value this firm? If you look up beta in Yahoo Finance, then you use 1.71. But is that the right answer? 1.71. That's where they ended up, right? That's the end point. So let's redo this whole thing. And let's start our rolling beta. Let's see. Let's start it from here. Could I sue Zoom for anxiety or whatever? I would like to hear the meeting when they say, hey, let's use the escape key. No one ever uses the escape key. All right, so there you have it. Not a very good looking chart, so let's get rid of some stuff. Now the median's right at like 1.5, 1.6, definitely never below 0. I mean, below 1, up to 2. Yeah, 1.5, 1.6 kind of makes sense for NVIDIA. We're going to talk about how we're actually going to come up with this number. But if you look at this and someone says, hey, I just valued NVIDIA, and you say, well, what beta did you use? Oh, use 0.63. Okay, what are you thinking? It's 0.63. What do you think? Is this Walmart? This is NVIDIA. They're selling stuff that goes into high priced items. That makes sense. Or you say, I'm looking at NVIDIA, I'm gonna use a beta of 7.3. But that's ridiculous. Betas are rarely above 3, and there's nothing in their history that supports that. So you see that moving around all over the place. So it gives you one input for the company, it gives you some help. But if you see something like this, where it's just so radical, and then it settles down into a range, this is probably what the market's going to be using for their beta for NVIDIA. The very last number, the number that Yahoo Finance is showing, doesn't look like a bad number for NVIDIA, but there are many times where it looks like a horrible number for a firm. I've seen Walmart where the last number is negative 0.15. I'm not going to use a negative beta for Walmart. That doesn't make sense. So sometimes the last number, a lot of times the last number is a perfectly reasonable number. They just happen to be right at their median. But if you're sitting right here, you'd be using a pretty high beta, and you'd probably get such a low valuation for NVIDIA, you would never buy the stock. If you're sitting right here, you probably get a valuation of the stock to be so high, you'd be putting your whole portfolio into it. Neither of those is correct. But how do we pick a number? So that's kind of a challenge with beta. What do we pick? So let's go through this process, and then next class I'll show you a little bit more kind of how diversification works. All right, so let's get a definition real clear on what systematic, unsystematic risk are. So systematic risk are those things that are just part of every asset. Every asset has some exposure to the overall economy, to inflation, interest rates, geopolitical events. Every stock has some exposure, not the same amount, Walmart has a lot more exposure to the overall economy. It does better during weak economies, kind of is the place to go to. Ford is extremely sensitive to the economy. People don't buy as many cars. So cyclical defensive stocks. There are some companies that are much more sensitive to inflation. So when inflation's in the news, you'll see some companies' betas go up versus others. It's not that their risk has risen necessarily. It's more that the biggest risk everybody's talking about affects them more than other companies. Some companies like banks, very, very sensitive to interest rates. Some companies may be more sensitive to the US dollar, and that might be causing them. So we don't know what the actual systematic risk is. And that's one of the reasons betas are not stable over time, because there's different things that people are worried about at any given time. But I tend to think of systematic risk as your exposure to the overall economy. Is it a cyclical stock or a defensive stock? So every stock has systematic risk, but at different levels. And that's what beta is going to tell us. Beta is not a measure of systematic risk. Beta is a measure of relative systematic risk. Relative is very, very important. I used to, on the final, have a defined beta question. I've taken that out, but I would have counted off if you didn't say the word relative. Beta is not a measure of systematic risks. This is actually one of the questions I used to ask when I interviewed. Describe the capital asset pricing model, define beta. And I think I got one good answer out of interviewing like 80 students. So somehow we're not teaching it, or y'all are learning it, or some combination of the two. So a lot of students just can't talk beta. Beta is, the most famous formula in all of finance. It's the most quoted formula. I mean, it's driven a lot of things. You should really know it backwards and forwards. It's an extremely important theory. So beta is a relative systematic risk of individual stocks relative to the market. We used to find that as the S&P 500. It's used in the capital asset pricing model, which is a one-factor model. There are other models out there. The arbitrage pricing theory model, MSCI had that. I think they got that, actually got bought out by somebody else. So I don't think I can. Well, let's see, can I actually get into that? I don't know if I marked it or not. I don't think I did. So factory dash story, I'll try to remember. Let's see. I have no idea if I can get in the right place. Page not found, of course. What was it? Factor store. Oh, why did I say factory? That doesn't even make any sense. Yeah, it's a multi-factor model, so it should have been factor. Yeah. So here it is. So if you hear factor models, now here's something. There's certain phrases that when you say them, you just sound smarter than all other undergraduate students. Here's one of them. So they're asking you, hey, you want to work here? What do you do with your own personal portfolio? Well, I built this multi-factor proprietary screening model. That just sounds really, really good. What does factor model mean? It just means you have data that you're using, turnover, margins, whatever. Multi-factor model. It's proprietary, means you built it. Someone else didn't build it. It's a model, just means you're in Excel or something. It doesn't have to be all that fancy. Sounds really cool, especially if you're talking to the human resource person. Anything you sound, because they're not in finance. So yeah, proprietary. Wow, the guy said he built a multi-factor proprietary, something like it. Just sounded really cool, whatever he's doing. So it's easy to press people that aren't finance majors, but that's what this is a factor model. So the question is, what are their factors? They used to give them out in detail. Now what they do is kind of give you a general sense. So value, we already talked about that. Value versus growth. Size of the company, small cap, large cap. Momentum, you know what momentum is? The easiest way, I remember Cliff Asness saying this, momentum is simply, you look at the stock price today and see if it's higher than it was a year ago. What do you know about momentum? Stocks are going up, tend to keep going up. Stocks are going down, tend to keep going down. Until when? Until they stop. But that's what momentum is. Momentum is out there. It works really, really well. If you just go out and buy stocks that are above their 52, average or 200-day moving average, it tends to work pretty well. Volatility there. We just said volatility is not important. Their factor model says, is it important? So there's right there. Dividend yield. That's easy to measure. Dividend yield. Anytime you see the word yield, you're taking dividend divided by the price of the stock. Dividend yield, that's there. Quality, we talked some about quality. So these two contradict each other, don't they? Value stocks are cheap, but they're low quality. So they have that in there. So they prefer inexpensive stocks, but then they have quality in there. Quality stocks are more expensive. So their model has both of those things in there. They have growth in there as well. They have liquidity. Liquidity, they look at trading volume, but they don't tell you exactly how they do it. Why? Because you're supposed to send them money and they'll do it for you. So there's our model. They have mutual funds or portfolios you can buy using their factor models. We've hired, when I was at USA, we hired several factor model firms. They all sound so sophisticated. When I retired from USA, that summer I went out and visited a bunch of our firms, and I went to one of our factor firms. I was expecting to walk into this massive computer room, bunch of scientists, everything's churning, all that. And they said, no, our model's over there. It's on Fred's desk. And I go to Fred's desk. He's got an Excel. I was like, your whole company is on Fred's desk. That seems really scary to me. I hope Fred doesn't get sick. But yeah, they just said their factor model was just one guy's computer. So this is a famous model they bought from Bar Rosenthal. So the Barra model, you may have heard of the Barra model. That's probably the most famous one. So they bought it from him. It's just essentially what it says is don't hire analysts to look at stocks. You hire computer geeks and statisticians and mathematicians. You get as much data as you can get. You're trying to figure out what data predicts where stocks are going. You put that into the model. Some models, you have a bunch of factors here, right? So, boy, I don't know what that's telling you. There's some interesting stuff in here. You have all these factors, and they may not all work. I talked about this a couple weeks ago in the Investment Society, but if they work 52% of the time, some will work, some won't work. But as on average, they work more than they don't. You've got something to work with. It's going to work really, really well. They better work more than most of the time, but it's a good chance 3 of these are not working at all, but 4 of them working really, really well. And so you beat the market. That's the theory. Are there times where they all fail at the same time? Unlikely, but there are times where these models are just absolutely horrible. So 2007 is a good example. 2007, these things just blew up. This terrible, terrible year for hedge funds. And then 2008 happened. So maybe they were predicting 2008. Maybe that's the reason their models didn't work, because 2007 was telling us, hey, something different is coming. But yeah, they really, really blew up. But here they give you a little bit more. So value price, book the price, which is actually price to book. That's the traditional manner. Earnings yield is pretty easy. If dividend yield is dividends over price, what is earnings yield? Earnings per share divided by price. What's the flip of that? PE ratio. So they say book the price, but that's the price to book ratio. Earnings yield, that's the PE ratio. And long-term reversal they're just kind of looking at just what earning revisions are doing. Size, momentum is momentum quality. How much debt do they have? How volatile their earnings? How reliable? A lot of times earnings quality is just how reliant are they on accruals. So I worked with an insurance company. Their entire liability is 80-90% reserves. What are reserves? Reserves are guesses actuaries make to try to figure out what they're going to pay out. Their reserves are plus or minus 3-4%, which means their earnings could be off 200% just because they thought it was 3 billion. It was actually 3.2 billion. So quality doesn't like companies like that. They don't like companies where you're relying a lot on estimates. Investment quality, profitability, dividend yield, pretty straightforward. On volatility, have beta in there. Growth is just the growth, and liquidity is, you know, how many shares trade. So we teach CAPM in a lot of finance classes if that's the only choice, but it's not. There's other models out there, and if you want to buy this model from MSCI or other models out there, I mentioned James Simons. He was at Renaissance. That was a factor model that did extremely well. So there's models out there, or you could create your own model. There was a guy, I had lunch with him. His dad said, "Hey, come have lunch with my son." He was a pre-med, and he left lunch, dropped out of school, and became a finance MBA, and now he's in finance. So his dad's like, "Yeah, he had a huge impact on his life." I'm like, "Yeah, it's kind of scary. Hope he does well." But he's building factor models and working for hedge funds and that kind of stuff. So, you know, that's his thing. He's very mathematical. His dad's very mathematical. If you got a strong degree in math, then that's what you do, is factors models. But we're going to use capital asset pricing model. So for paper 3, you're going to use CAPM. A stock with a high beta is a cyclical stock. And that's essentially the definition. Cyclical stocks have high betas. Defensive stocks have low betas. If Apple's beta is 1.2, that means they have 20% more systematic risk than the average stock. So they're a more cyclical stock. Now, betas are unlimited. You can have a negative 3 trillion beta. You can have a beta of 87 trillion. It's unlimited. But for stocks, the normal range is 0.4 to 3. 0.4 would be like grocery stores. 3 would be heavy industry, you know, very, very expensive products. So on paper 3, strongly recommend you don't have a beta below 0.4, above 3. Or if you do, come talk to me, because that's going to be a really unusual beta. Beta can be just calculated. That's called the regression beta. But I don't believe that. To me, beta is a forecast, just like anything else you forecast for a stock. So beta is not a number you look up in Yahoo Finance. It's a number you've got to determine yourself to try to figure out what you think makes sense for your company. That's what you're going to be doing in paper 3, is you're going to come up with the assumptions for the capital asset pricing model. I like paper 3 because if you get the question about CAPM, you'll have a really good answer because you just wrote a paper about it. So you'll be in good shape on that. Yeah, I remember one student gave me a great answer, and I think it was a UTSA student, but it was really frustrating. I had students in my class that gave bad answers in the interview. I'm like, don't you remember we talked about this in class, but I couldn't say that. I had to pretend like I didn't know them, but it's like so discouraging. Y'all need to know this. It's always the question I always ask. You're a finance professional. That means you know stuff 99.99% of the world doesn't know. What do you know that the rest of the world doesn't know? For most finance students is, well, I can look it up on Investopedia, but that doesn't count. That's your doctor getting the anatomy book out. What do you know in a nanosecond off the top of your head? And CAPM is one of those things you should just know. I remember when I did the CFA exam, I was in a review class, and CAPM to me is just so simple. It's only 3 numbers. You just plug them into a formula. And at the end of review session, 2 guys on the front row was like, "What's this CAPM thing in beta?" I was like, "Good, I'm going to do better than they're going to do." It's like, how could you at the end of the class how could you not know that and you're taking the exam? Didn't make sense to me. And the CFA exam, when I took it, it was essays in the morning and multiple choice in the afternoon. The essays were a little tough, but I felt really good about it. The multiple choice, I knew I aced the multiple choice because I think at least 10% of the questions were plug 3 numbers in a CAPM formula. Like, how much easier can you get? I can plug 3 numbers in, and they kept asking that same question over and over. It's, you know, slightly differently worded, but so it's important. It was a big part of the part 1 of the CFA exam. We ask it a lot. I doubt they're going to ask an APT question. They could, but it's not as common as definitely not as common as the capital asset pricing model. So what's the big problem with beta? if beta really was a good measure of risk, it should be fairly stable over time. But you saw with NVIDIA, it ranged like from 1.2 up to 2. That's a really wide range. You can get radically different valuations for NVIDIA. Why is it ranging like that? Well, you can't say it's because NVIDIA is changing their business model. It's not like they're selling one thing and something else and switching around. It just has to do with that noise. Sometimes the market's focused on inflation. Sometimes it's focused on interest rates, sometimes the economy, whatever it's focused on, and certain stocks are more exposed to systematic risk than others. But the capital asset pricing model is a one factor model. It assumes all stocks can be explained by the relationship to the stock market, but there's a lot of things going on. So the APT makes more sense, doesn't it? Just theoretically, you should have other factors. The question is, the APT models give you better stock returns than CAPM? And the jury's out on that because it's hard to actually compare those. So beta is a forecast, just like your growth rate. So then unsystematic risk. What is an unsystematic risk? Those are the things that are specific to your company. If you're going to talk about it in an interview, use this word. Unsystematic risk, also known as idiosyncratic risk. That's a much cooler word, isn't it? I have a well-diversified portfolio. I've really limited my idiosyncratic risk. That's going to sound cool in the interview if you can actually say it. So you practice it a little bit. You want to be parsimonious and eliminate idiosyncratic risk. So the CEO dies. That could be important. You have some new product that comes in. That's what Meta's trying right now with the VR and that kind of thing, how that's going to work. A firm that's been 99% advertising, now it's going to try to actually get into other markets. Moving overseas or in the new markets, that's specific to the company. A competitor does something like Apple really limited Google and Facebook on what they could do with the data they got. That helps Apple, hurts those two firms. Some new drug, some disaster of a headline hits the firm, like Facebook today or Netflix. We can ignore these risks. Why? And that's an important word. He didn't say minimize these risks. He says ignore them. Pretend like they're not even there. Why? Because we can eliminate them really easily. In fact, with one phone call, you can take your unsystematic risk to zero. You just call up Vanguard, buy their all US stock fund. You have every stock in US, you have zero unsystematic risk. It's completely gone because you have every stock you can possibly own. So there shouldn't be any adjustment for the risk premium for your stock for unsystematic risk, which explains why companies go public. So HEB hasn't gone public. They need to. It's going to depend how many butts you have. So right now, if you only have 2 or 3 butts, they may be okay. But once you get the grandkids and great grandkids and they're splitting this company among 50, 100 people, they're wanting to go public. Why? It gets pretty obvious when you look at the numbers. I'll use Borna's chart here. Let's say HEB's free cash flow is, I have no idea what it is, but let's say it's 500 million. I have no earthly idea. And let's use a discount rate. Well, the Butt family, did they have a diversified portfolio? They don't. All they have is HEB. So what discount rate do we have to use? We have to base it on total risk. Let's say that's 42%. Let's say their growth is, say, 5%. So how much are they worth? We take 500 divided by 0.42 minus 5. And they're worth $1.3 billion. And then they go public. Well, now they're part of a well-diversified portfolio. And it's a grocery store. What kind of beta does a grocery store have? Really, really low. So their discount rate might be 6%. Now their value's 50 billion. Does the Butt family want to be worth 1.3 billion or would be worth 50 billion? Which would you think they would prefer? They can increase their wealth 3,600% by going public. Do you think there's an incentive for them to go public? Absolutely. Zuckerberg didn't want to go public. Why did he go public? Because his net worth goes up from a few $1 billion to tens of billions of dollars, just like that. I mean, it's really hard. So the HEB family say, we don't want to go public. We don't go public. That's fine until they're going to have, once you get down to 50, 60 grandkids, let's say they have 100 grandkids, they're each going to have $13 million. They say, you mean if we go public, will we be worth $500 million? Yeah, let's go public. That sounds good to me. I like 500 million a lot more than 13 million. So I don't know anything about the Butt family, how many kids they have or grandkids. So that's why that's why firms go public. You immediately go from using total risk as your discount rate to using systematic risk. And that means 75% of your risk disappears just like that. Your discount rate falls dramatically. The value of the firm goes up thousands of percents. It's really amazing. I'll show you this one next class. So, all right. So let's say someone says stock betas rose in 2008 due to the financial crisis. I think we talked about this last class, didn't we? Can betas rise because of the financial crisis? Not possible. Why? Because the beta of the stock market is always 1. So bank stock betas went up in 2008 because of a banking crisis. So Citibank's beta went from 1.5 to 3.5. Someone else's beta must have dropped because the market's always 1. So betas don't rise because of a crisis, because the market's beta is always 1. Certain sectors betas rise, other sectors fall. So during the 2000 .com crisis, tech stock betas shot up. In 2008, bank stock betas shot up, but then others shot down. So the market's always at 1. I've seen this on an exam before. Your stock has a beta of 1.1. S&P rises 10%. What does your stock do? And the answer is 11%. That's absolutely false. Remember, beta is only capturing about 25% what's going on with the stock. It's possible they have a beta of 1.1 and the S&P is up 10% and they're up 47% because they had some new product approved. Or it could be they could be down 20%. So we know Facebook has a beta of what, 1.5. The market's up 1% today. They should be up 1.5% today, but they're down 20-something% today. So you can't use the beta to say what the stock price is going to be. Now you could do that with your portfolio. Your portfolio has a beta of 1.1. Your portfolio should be up 11%. That you can get some sense of. You may not because you didn't do a good job picking stocks, but that would be the right answer. But for an individual stock, if you ever see this question, the answer is, I don't know. Maybe 11 is the best answer, but it's not that much more probable to anything else because there's so much noise here. As far as doing the rolling beta, I have this file that shows you how to do it. You saw me today do the 5-year rolling. So you have this to help you with paper 3. So that'll help you make sure you know how to do it. I think I'm the only professor that does the rolling beta because most professors do this. This is probably what you're used to seeing in your other classes. Does this look familiar? Y'all did that, right? Anybody remember doing this? I don't like this because I don't know which point is which. I want to look at it over time. It makes more sense than over time. That's just the entire period, and just the slope of that is the beta. That's fine, but does that picture tell you much? Doesn't really, to me, it doesn't tell you much. I think this tells me a whole lot more. I just like that. I've had professors say, "Why do you do that?" And some don't like it because we're supposed to teach you that beta is sacrosanct. There's no problems with it. It works perfectly. We don't want to show charts like this because it messes that all up. Because beta is a very volatile. It shouldn't be that volatile, but it's very, very volatile. But I think you just got to know this, that using and if you have a class where they just use regression betas, I think you should really push back on that. Why should I get my beta from Yahoo Finance? That's just the last 5 years monthly. Does the last 5 years really define this firm going forward? We had COVID just a couple of years ago. That probably influences these betas quite a bit. Is that what you're expecting, another pandemic the next 5 years? Or maybe something else is going to hit. Who knows what's going to go on? If I'm doing semiconductors, what do you think my biggest concern is right now? Probably Taiwan. And President Xi, probably, if he's replacing his market-friendly members and putting military people in place, that makes me a little nervous if I'm Taiwan. What happens if they attack Taiwan to semiconductor stocks? That's going to be pretty interesting, isn't it? Now, I know those Taiwanese companies are starting to build plants overseas, so that helps some, but if all their leaders are in jail or whatever, so, you know, you got to really think about what's going on in markets and those kind of things. When you really think about what's a systematic risk this company has. All right, so what we'll do next class, I want to show you just mathematically how diversification works. And then we're going to go through this process. If you haven't before, you've done this before, but this is essentially paper 3. We're going to walk through this process and I'll give you some examples of how you actually forecast a beta. All right, I'll let you go there.